Let's turn now to the global banking crisis and the news that Credit Suisse is being taken over by Switzerland's largest bank, UBS. Now, this move is a hastily brokered deal. It was brought about by government pressure, and it follows the collapse of two banks in the United States earlier this month. It might be easy to say those events did not happen here in Canada, but will they actually have a ripple effect on this country? To talk about this, we're now joined by the chief economist for the Conference Board of Canada, Pedro Antunes. Pedro, nice seeing you again. Thank you for joining us tonight.
It's a pleasure. Thanks for having me.
Listen, a lot to talk about here, but I want to set the stage, if you will, right off top, because Credit Suisse was considered one of the most influential, important banks in the world. How could this happen?
Well, I think we were all a little bit surprised about what's developed over the last few days in the banking world. But certainly, I think there were signs that Credit Suisse, for those that were watching that company carefully, signs that things weren't going well. It had been involved in some fraud. It had been involved in tax evasion. We know that it had suffered losses year after year. And in fact, its share values had been declining since at least 2022 quite precipitously. So, I think what's common about what's happened to the three or four banks that have been affected is that there's a lot more scrutiny now that one has failed. The kind of social media-driven scrutiny has grown, and really no bank can suffer a bank run if there's starts to be concern, a loss of confidence. So I think that's what's common for all of the banks that we've seen troubled. But Credit Suisse, I think, came in with a lot of problems prior to interest rate increases or any of the other issues that we've seen affecting the banking sector.
Okay, let's build on that because, as you say, this is all tied to a run on the bank. And not only is it Credit Suisse that we're talking about here, there was also those other two financial banks in the United States crumbling under financial pressure, Silicon Valley Bank and Signature Bank. There's also even a third bank that's teetering, First Republic in the U.S., all of that brought on by the U.S. Fed and rising interest rates. How are those collapses essentially tied to U.S. monetary policy?
Well, again, I don't think all of them are facing exactly the same pressures, but certainly all of them are facing more and more scrutiny because one has failed. Now there's a lot of concern. So certainly I think that's what ties them all together. But if we look at SVB, for example, really that bank had not diversified its assets. Banks take in deposits. They put those deposits in investments, and then they lend, essentially their money, in the case of SVB, to the tech sector in Silicon Valley. So, what happened here? Well, SVB did not diversify its portfolio. It invested mostly in U.S. long-term bonds, U.S. government-issued bonds. Those bonds, of course, prior to inflation and the interest rate hikes that we've seen recently, were paying very low rates of return. And so as interest rates started to come up, or in the last year, when central banks have been putting the brakes very hard or trying to put the brakes very hard on inflation, the book value of those assets declined. And, all of a sudden there was scrutiny, there was social media, and essentially it suffered a bank run. It was unable to meet its financial obligations because people wanted to get their deposits back, and the bank essentially failed.
Now, you mentioned the central bank, and of course the central bank in this country, along with the U.S. Fed and the central banks of England, Japan, the EU, Switzerland, they announced a joint move to guarantee liquidity in the market. And this has something to do with liquidity swap arrangements. Talk to us about how that works and how it would theoretically provide greater confidence in the system right now.
Well, I think this is essentially an arrangement among the central banks, as you've mentioned. I think we saw some of that happening or starting to happen, certainly during the financial crisis, 2008 and 9. And the arrangements that were in place are now kind of being pushed forward. We're seeing more money injected or potentially injected into the system, into the swaps. But the swaps really are essentially an intercentral bank line of credit. And that's if, there's pressure on any one central bank. The other central banks have essentially a backstop to fill in should there be a need. It really is another gesture to try and rebuild confidence in the system. Banks are built on confidence. No bank no individual bank can suffer a bank run without failing, essentially, because they just don't have all of the assets liquid to be able to pay back depositors. So what they need to have is confidence that they are able to pay back depositors, so that there's no rush like this. And that's what we're trying to build here. What central banks are trying to build, with this move.
Okay, so if it's about building confidence, do Canadians need to be worried right now by all this financial turmoil? Will this become another 2008 financial crisis?
Well, as you may recall, in 2008, 2009, chartered banks here in Canada did actually quite well compared to most banks globally. And that is because we're, I think, a little more prudent, certainly in terms of taking on mortgage-backed securities. There's very little of that happening in the big Canadian banks. And the fact that we do have, a smaller number of banks, big banks, but a smaller number. If you compare to the U.S., if you add up the kind of national and regional banks, there's close to 4,000 banks in the U.S. Here in Canada, we're much more limited. So in some ways, less competition, but in other ways, these banks are bigger, they're more secure. They tend to be, a lot of the deposits are insured, backstopped. We have our regulator doing demanding stress tests from the central banks. From the chartered banks, so that we know that they can withstand, a lot of stress. And so there's, I think, nothing really to suggest that there's going to be any problems for any of the big banks in Canada from this. I think the impacts will more so be indirect on the economy should we start to see, essentially problems of confidence in terms of driving economic activity globally. And, if we see the U.S. or the global economy in more trouble than it already is, because we're heading into a very weak 2023, then obviously this would play itself out in terms of our own trade and our own economic performance.
Well, then quickly losing time, but I have to ask you then, if that's the commercial banks, what about the central bank? Will what's happening right now give the Bank of Canada any kind of pause if they're thinking of raising interest rates again?
Yeah, I think in Canada we were already pretty certain that we were going to see a pause, assuming inflation keeps going in the right direction. We'll see tomorrow if that's the case for February. But more so for the U.S., I think just prior to these kind of hiccups in the banking sector, we'd heard Jerome Powell talking about potentially increasing rates even further to really press the brakes on inflation. He may take a pause on that, and in fact, now we're hearing a little bit more about potentially seeing lower rates, perhaps even later this year. So I do think this has stressed the system, adds uncertainty, it's taken wealth out of equity markets. It is another, how should I say, another break on the economy, if you'd like, that's doing the job here.
Pedro, really appreciate the time today. Thank you for that.
You're welcome. Thanks for having me.